Hi there, this is Andrew, professional risk manager, or should I say former professional risk manager. There's a minor update to my professional life, and that is that approximately 2.5 weeks ago, I left my role as a hedge fund risk manager, and now I'm working at another firm, dedicating my time to issues of risk, treasury, and the like, but in a very different space. That said, the goals that I have for this channel and the lessons that I hope to teach, the ideas I hope to imbue in you, I think are as relevant as ever, and I am hopefully still qualified to deliver them. So with that, a little bit of housekeeping, so to speak, and that is that, better or worse, I've posted a couple of videos over the past few weeks, and uptake has been minimal. Not to say that that is a problem necessarily, but to the extent that I am going to continue disseminating information and producing episodes, I would like to know that there's an audience listening. So to the extent that you're out there, I did say in my first video I would be the type not to say like and subscribe, and I'm not going to say that today, but to the extent that you enjoy the video, leave a comment, ask questions, to the extent that I can see some engagement will help obviously propel along my ability to produce these types of videos and do so in a more timely manner. Now that said, there's kind of two topics I want to touch on today. First, I'd like to talk a little bit about my thoughts on the current market scenario, and then follow up with some practical tips for people at home, and that is on the topic of tax loss harvesting. So the state of the world today is a little bit hazier than it was when I first posted a video with my thoughts on what was to shake out in the virus a few weeks back. That is, COVID-19 has firmly taken hold in the United States. My state of New Jersey has been under shelter-in-place orders now for quite some time. I have been home consecutively for about 25 days at this point, and it is leading to a number of challenges in the market. Now, what we've seen so far is a large uptick in unemployment that is going to have ripple effects up and down the economic environment. To start, any predominantly consumer-facing organizations, retail stores and the like, are going to see a hit because people are not going to be willing to go, or hopefully are not going to be going to those types of stores. People should be staying at home as much as possible, and I hope you do the same, except to go and retrieve provisions at your local food store. Now, to that extent, that should help some companies thrive in this scenario. Costco is one that I can think seems particularly buoyant these days. That said, it would depress overall spending and have a broad-based impact on the economy. Then, number two is that things are going to continue to evolve, and the unemployment numbers are likely to increase. We are still at a point where COVID is reproducing at a rate of about 2.0, so roughly 2 new infections per day per recently infected person, per contagious person. So we are still on somewhat of an exponential growth curve, but that growth is slowing somewhat. We were at, I think, 2.67 infections per person just a few days back. So hopefully the slope of that curve is going from exponential to linear to hopefully flat. We will see how that takes hold over the next month at least, but everybody stay safe, stay at home, follow the guidelines of the CDC and NIH, and do everything that you can to minimize your impact and practice good social distancing. But there are a couple of downsides to this for stocks and for the economy, obviously. People aren't going out, they're not spending money. They're not spending money. Corporations find it difficult to make payroll, to pay rent. There will be layoffs, as recent unemployment has shown. I know personally I've seen multiple people in my immediate family get laid off or be put in suspension. I've seen people in high positions of the US government, in agencies that you would expect to be resilient to this, be put on some sort of stay-at-home measure. And that leads to potential problems. Number two, why are we seeing so much pain in the financial sector? Specifically, companies that issue consumer credit. Now, I myself am a big booster of a few financial companies. I like Discover Financial Services. I like PayPal. But the expectation is that companies like these will see increasing defaults in consumer credit cards, that there will be an increase in bankruptcies, and that the first thing that people will stop paying will be credit cards and the like. So you'd expect to be some continued pain there. I'm not going to touch upon sectors that are effectively shut down for this: airlines, consumer travel, tourism, things like that. I personally have bought into some of those on the dip, but I don't know that I could recommend that for others. I have personally seen them continue to crater well beyond where I thought was feasible, and that was likely some unnecessary optimism on my part. Once credit cards are hit, though, on secondary impact both on financial companies and then on and beyond, is that there may come a point where unemployment becomes a big enough problem that we are looking at mass defaults on mortgages again. So it would effectively replay some of 2018 within this cycle. Now, I think financial institutions are generally much better prepared, and I don't think I still stand by my original statement that I do not think this is an existential crisis for the global financial institutions. I think the likes of Goldman, Bank of America, JP Morgan, and the like are in much better shape than they were in 2008. And I think that they will easily outlast this crisis, but they will be feeling quite a bit of pain. So it's something that, earlier phases of this cycle, I viewed as opportunities to potentially buy in cheaper. I see a lot of chatter from friends, family, miscellaneous trolls on the internet about how this is the time to buy now that things are cheap. As much as I was buying 2-3 weeks ago, my attitudes have soured a little bit. Not so much that I'm selling any recent positions I put on, but I see some chatter from people who traditionally have not invested or have been resistant to investing in my circle that makes me think that this could be some sort of false summer, that things are flat to decent in the last few days. We've had a couple of good up days. Last week we had 3 up days in a row, and you may think, okay, we're breaking out of, the market has found a floor. I don't know that we've seen all that we're going to see from COVID, and I don't know that we're done with the pain that we're in now. So to the extent that you have sat on the sidelines with dry powder to this point, I'd recommend to continue to do so. I know my plan to be fully invested throughout this cycle has been put on pause, and that any outstanding dry powder I have is sitting dormant. I would potentially look at that for yourself in the future. But then onto the topic at hand, the one that I wanted to discuss, something that may be relevant to an increasing number of people out there. That is tax loss harvesting. Because just because I'm not recommending to go out and put on new positions or increase positions doesn't mean that you can't do things that are advantageous for your portfolio today. So what is tax loss harvesting? The thought is that on one hand, when you sell an asset, you are realizing losses. You are incurring some pain. But those tax losses do have value to you. They are write-offs on your income tax at the end of this calendar year. And that is now dollar for dollar removed from your current income and can save you money in taxes. So the thought behind tax loss harvesting is that you incur losses now so you can potentially buy back at a lower price or someplace around the same price and realize those losses so you can pay less income tax in the short term. Now, part of that is the thought that, do you really want to, in a volatile time like this, pull all of your assets out? I said before, and I would say again, to the extent that you have assets in the market, you should stay put. Because more often than not, you've seen this in the past several weeks, the day after an 8% down day, you'll see a 5% bounce back. Most of the largest gains in history have happened in the wake of devastating losses. And if you were to realize a loss and then totally pull out of the market, there's a good chance that you can miss some or all of the rebound that would come from the market finding a floor. So the question then is, I sell an asset, what do I do with the cash? Do I pull cash out? I'm arguing obviously no. The next thing to do, though, is to think about what is a reasonably close proximity for the asset that you are liquidating. So a good example of that would be a common share that many investors hold is the S&P 500 ETF, SPY, or the Vanguard World VOO. Now, you could start with that and say, I have S&P exposure, but what is a reasonable proximity to S&P exposure? I would argue a reasonable proximity might be exposure to a fund balanced off of the Russell 1000 or balanced off of the Wilshire 5000. So another index that you could look at would be VTI, the Vanguard Total Market Index. That very closely tracks with the S&P index. So the S&P is the 500 largest companies in the US, but in practice, most of the other smaller companies don't move the needle quite as much. So by buying the Vanguard Total Market Index, you're buying the S&P plus a bunch of little things that are de minimis in the aggregate portfolio and de minimis on affecting returns. That is, it will likely not lead to a large upside or downside versus the S&P. You'll be seeing similar returns. So if you were to sell your SPYs and buy a bunch of VTIs in equal proportionate dollars, you can keep your money invested in the market in something that's going to behave similar to the S&P without being invested in the S&P. Because tax loss harvesting, tax loss realization laws in the tax code say that you cannot, if you are going to realize a loss, you cannot be invested in that asset or something materially identical to it for a 30-day period. So you can't sell the SPY and buy the VOO. They both track the same index. They are materially identical. But the VOO versus the VTI, they track different indices. They are subtly different. And for the purpose of the IRS, they are considered different assets. So by rolling one into the other, you can realize a tax loss while staying invested in the market. Doing this could help you on a after-tax basis on your personal portfolio and potentially can reap you several hundreds of thousands of dollars depending on how you're invested and what your income levels are at the end of the year. This is something I generally look at the end of the calendar year. The last time I did any tax loss harvesting was after the sell-off at the end of 2018. But that said, it's something you can do today. It should be noted that tax loss harvesting implies that you have a loss that you'd be realizing. So don't sell anything that if it dropped a third, but you've seen it previously run up 50, 100%, you are still in the money on this trade. You cannot do tax loss harvesting because your cost basis is too low. You want something where the current value of your asset is below cost basis, and any dollars below cost basis that it is are dollars that you can write off of your income. So with that, these are things that I hope you can consider. I hope you enjoyed this and found this informative. To the extent that you want to hear more about investing principles, tax savings strategies, risk mitigation strategies, or that you want to hear more about musings on markets, please let me know in the comments below. And to the extent that you can amass a stockpile of dry powder out there today, I think it's a good time to fund your accounts, if not the best time to invest, to put yourself into the market all the way to the hilt. I think leaving some amount of reserve for when we know that a floor has truly been found might be worthwhile. I think that floor will likely be found in the next few months, that hopefully by summer we will have a very firm grasp on both what will lead us out of the COVID panic and where the market economy and the global economy can go from there. But this is still all very hazy, and the risk manager in me, my crystal ball, is impossible to read these days. So stay out there, stay safe, stay at home, and good luck investing.